Hello, everyone. This is Colin Murphy from the Dassault Systems Benefits team. I'm here with Bill Manning, also from the DS Benefits team, and Kendall Storch from Arthur J. Gallagher. Today's presentation is going to have a review of our 401k plan and its performance. As part of this presentation, you will have an opportunity to ask questions through the GoToWebinar question box. So if you do have questions, please feel free to type them in. We'll answer some of those directly, and then we'll also ask some of the questions at the end to Kendall directly. We will keep the presentation to about an hour. If we don't get to your question, you can obviously reach out to Kendall. He's going to provide his information at the end of the webinar. And then finally, just some other notes. We will be recording this presentation. So both the recording of the presentation as well as the slide deck will be available out on rewards.3ds.com following today's webinar. I expect it'll be out there sometime on today's Tuesday, so sometime on Wednesday. That should be available if you want to see it in the future. But at this time, I'll turn it over to Kendall and let's get started.
Great. Thanks, Colin. I appreciate it. Good afternoon, or perhaps good morning to anybody out on the West Coast. I wanted to first thank everybody for taking a little bit of time to listen in today. We typically do this webinar about twice a year, usually once in the spring and once in the fall. So this is our fall version. So I'll move us on over to the agenda for today. So we have a variety of different things that we're going to cover. Just like Colin mentioned, I'm going to try and keep this to maybe 45 minutes of talking time to leave ourselves a little bit of time for some questions at the end. So in light of that, I may cover things relatively rapidly to try and make sure that we get through all the material. But to start with, we'll take a look at the markets and go over kind of what's been happening with the markets. Obviously, there's been a lot of flux in the last 3 weeks, so we'll talk a little bit about kind of what's been happening there. We'll turn our eye to how has that impacted the funds in the plan, so we can take a look at how the plan has been performing. I'm going to remind everybody about some changes that we made to the plan effective October 1st and what those changes look like. And then finally, I'd say the meat of the presentation really is around with the uptick in volatility in the markets. That gives us a good opportunity to maybe reassess what we're doing and remind ourselves of some basic financial truths that might help us better mitigate any sort of volatility or make sure that we stay on the right path. So those are really the topics that we're going to be covering today, and then we'll kind of open it up for some questions and see what people are curious about. So without further ado, we'll talk a little bit about the markets. So I always like to start with a slide that kind of looks backward in time to kind of get a sense of where we've come from versus where we are today. So I always think this slide is really interesting because you can see the degree to which we've had quite a bit of volatility in the market going back to 1997. So it's been something of an unusual time frame where we've had two very significant declines in the stock market. We had the internet bubble burst in 2000, followed by September 11th, which caused a 49% decline in the market. And then starting late in 2002, the market kind of bottomed out and began to recover. We get all the way out to 2008, where we have the financial crisis hit. And we have what is actually the second worst drop in the stock market behind the Great Depression, where from peak to trough, we lost 57%. And then from 2009 forward, it's been steady climb up. Interesting to see, from the very bottom of 2009 to the end of September of 2018, the market's up 331%. So even just kind of looking with the graph, it's not inconceivable for people to conclude that, wow, it hasn't necessarily been the smoothest of rides. There's been definite high highs and definite low lows. So that's kind of where we're coming from. I think that is built into everybody's psyche at this stage. For anybody who's been in the workforce since 1997, you had to live through all of that, which in some ways it can be hard, but is also, I think, a good thing for for people and investors to have a sense of what down markets are all about. So I have a couple of slides here looking at different kind of slices of the market. So this one is looking at various different industries, and these numbers are through the end of September. So if we look at kind of what areas the market have been doing well, or at least what segments of the market have been doing well, they've tended to trend towards technology, towards consumer discretionary, healthcare. Those have been kind of the big winners so far this year, and by and large, that is still the case even as we sit here today. The industries or sectors that haven't done so well: materials, consumer staples, industrials to some degree, financials. These ones have been kind of the laggards so far this year. So I think there's kind of two common themes. Technology, and this stretches back to 2017 as well, has really been leading the charge. Many of the big tech names, Apple, Google, Microsoft, Netflix, Facebook, these kind of names, Amazon, have seen momentous increases in their stock price and their share value, and that's really driven the market to a wide degree. And we'll take a slightly closer look at that. The consumer discretionary piece is really a function of the consumer seems to be spending again. As quarter over quarter, we've seen consumer spending continue to tick up. Roughly 70% of the growth of the U.S. economy is a function of consumer spending. So if we have people buying more things, that tends to help grow the economy, and as a result, industries or businesses that cater to consumer discretionary, to the consumer, those ones have profited so far this year. The ones that have really struggled have been the ones that have been more impacted by the trade wars or impending trade war, I guess you could say, or anyone who is reliant on particular raw materials, and in particular steel. So that would include the materials sector. That would include consumer staples, for example, and hence the reason those numbers are in the sellers so far this year. So through the end of September, from a return standpoint, we can see kind of where the markets were really not that long ago. And I've circled here in the middle of the screen the year-to-date results for these different components of the market. So right in smack dab in the middle, in the large row, the up 10.6%, that was the S&P 500 index through the end of September. So it's interesting to see, everybody is in positive territory. We've got some pretty good double-digit numbers on the growth side of the equation. The value side, not performing quite as well, but a lot of that has to do back to the sectors that I was pointing out, where consumer staples, industrials, materials, things like that tend to live on the value side of the equation. So hence the reason they haven't been doing so well. So it was a pretty good picture, I guess you could say, through the end of September. Just as a reminder to people, the market peaked on October 3rd. So that was the high for the market. That's not the high for 2018. That was the high period ever. So really not that long ago. I mean, we're looking about a month ago, we were at kind of the highest that we've ever been on the market. So this was kind of the picture a month ago. What does it look like now? So these are the numbers for those same different components of the market through Halloween, so through just a few days ago. So as you can see, our 17.5% return for large growth stocks has dwindled now to a 6.2% return. Our 15-odd% return for mid-cap growth stocks is now down to 2.2%. And you can see the value side of the equation is now into negative territory. So a lot of change really has occurred in the last month. Mind you, if you look at the results today, and obviously it's pretty fluid, things have improved from here. The market's had 3-4 pretty good days in a row right now, so it's regained some ground, but it's certainly not back to where it was as of October 3rd. So, interesting to look at some of these big tech stock names. So I was mentioning those before, that these ones have tended to drive a lot of the return of the market. But these were the returns for some very popular stocks for the month of October. Amazon off 20%, Netflix off just under 20%, Google down about 10%, et cetera. And I think it's also interesting to note, how much of some of the indexes that we tend to track are represented by just these stocks here. So 16.3% of the S&P 500 index is represented by these 6 names. And nearly 25% of the NASDAQ is represented by these 6 names. So to some degree, as these 6 stocks go, so go many of the broader indexes, because they're such big components of the index itself. So the chart that I'm showing here is a chart of the VIX, or the Chicago Board of Trade Volatility Index. The VIX has a less appealing name, is commonly referred to as the fear index. So it's a common index for people to track to try and get a sense of sentiment and how people are feeling about the markets. So as you can see, coming out of August, we've got a very flat VIX, not a lot of volatility out there. We get into October and the line really begins to move around. So we have a big uptick in volatility in October. So again, a little bit of perspective on this. If one of the hallmarks of 2017, so 2017 was a great year for the stock market. It was the S&P 500 index was up a little over 21%. So great year for the stock market. One of the key pieces to last year was that there was little or no volatility. So the VIX for 2017 looks very similar to kind of what the chart looks like here from August 6th through October 1st. Very, very flat. Very few days of panic or nervousness in 2017. So it's interesting to see some of those kind of concerns, I guess you could say, come back this year, and the last month has been a pretty good example of that. So, so why? What has been happening that's caused the market to become more volatile? So there's really kind of 5 different things going on right now that seem to be weighing on investors' shoulders. So number one is concern about interest rates and what's going to happen to the economy as interest rates continue to go up. We'll talk a little bit about that in a second. Some worry about future earnings for companies. Are companies are they going to continue to be as profitable as they have been in the past? We've had quarter over quarter of record corporate earnings, but in October, people were starting to kind of scratch their heads a little bit and ask themselves the question, how long can this continue? At some point, corporate earnings are bound to, at a minimum, just flatten out. What kind of impact are some of the trade policies going to have on the economy? So as these tariffs go into place, how are they going to impact different businesses? How are they going to impact trade? We don't know the answer of that quite yet, but we're starting to see signs in certain industries, and I'll show you a slide along those lines. Some worry about China, and China is the second largest economy in the world. We are seeing signs of China beginning to slow and their growth rate beginning to slow. So that has raised some concerns for people about, okay, if China is not going to export as much, if China isn't going to use as much resources, materials, and things like that, how is that going to impact the global economy? And if it does impact the global economy, will that cause the global economy to slow down, which is the 5th concern that was or even is at play right now. So let's take a look at a couple of slides here to kind of talk about these different points. Number one is around interest rates. So I have, if everybody was in the room with me, I'd play a little game of who's who in the news. So the picture in the upper left-hand corner is the chairman of the Federal Reserve, Jay Powell. So last month, Jay Powell had some comments about the Fed's attitude towards interest rates and whether they would continue to try and keep raising interest rates even in light of some of the volatility happening in the stock market. And the reading the tea leaves around his comments, the feeling was that the Fed was going to sort of stick to the plan, and the market didn't like that so much. So we've had 8 different instances so far of the Federal Reserve raising interest rates going back to late 15, early 16 forward. The feeling is that the Fed will raise interest rates again another 3 times next year. So the big concern with interest rates is if you're a business and you need to borrow capital, the cost of a borrowing is going to go up, which is going to eat into your profits. And then secondarily, as interest rates go up, it makes different types of investments look more attractive, less risky investments. So that might be bonds, or that might be cash, or something like that. And therefore, you'd have a reduce in demand for stocks because you can get a better rate of return out of something that has less volatility. So this is definitely a big component of what was worrying the market, was where is the Fed going to go with interest rates? You can kind of see on this chart, the blue line is basically showing where the Fed thinks interest rates are going to be going out into the future. It's kind of a maroon color is where the market thinks interest rates are going to be. Either way, somewhere around 3% is probably going to be where interest rates will ultimately settle out, which, in the grand scheme of things doesn't sound like a lot, but from where we've come from, and you can kind of see from 2008 forward, where interest rates are basically zero, rates have come up quite a bit. China was something else that I had mentioned before, so we got a couple of slides here looking at some different sort of components of China. I think what I draw your attention to on the left-hand side is around industrial production. So you can kind of see from 17 forward, we've had a dip in industrial activity in China, hence the China slowing down consideration. And we've also had an uptick in debt for Chinese investors or Chinese residents. Consumer debt or private sector debt has gone up quite a bit. So these were some of the other things that people were looking at to say, is China going to continue to grow at the 8%, 9%, 10% rates that we've seen historically? The tariff situation is also out there. Definitely a concern for the markets. I thought this was sort of interesting. So you can imagine if you were in the laundry equipment business, one of the big components to your business might be steel. So you can see where laundry equipment prices have gone since the institution of the steel tariff at the beginning of the year. So we've seen a big spike in the price of washers, dryers, etc. since the beginning of the year. That's purely Whirlpool and Kenmore and things like that, just passing on the 25% increase in steel costs to the consumer. So, as these tariffs begin to spread out beyond just kind of a relatively narrow number of businesses or industries, as it gets broader, we may begin to see much more price increase or passing along the tariff cost to the consumer, which would be inflationary, not necessarily such a good thing. So what does the outlook look like? What are our kind of thoughts putting all this together? It's hard to kind of see where everything is going to go ultimately, but at the end of the day, the U.S. economy does appear to be strong. So the growth rate for the U.S. economy has been particularly strong this year, whether that's due to the tax cuts, whether that's again due to improved corporate earnings. We have very low unemployment. Even with interest rates going up, they're low in the grand scheme of things. We haven't seen too much inflation. We've seen a little bit, but not too much, very manageable. So the U.S. economy is strong, but we're kind of getting towards the latter days, I guess you could say, of the business cycle. So hence the reason as the Fed begins to tighten interest rates, we may see that have more of an effect on businesses as a whole because we're getting to be kind of late in the game. We do think rates are going to continue to rise. We don't necessarily forecast the Fed slowing down too much, so we'll have to see how businesses absorb higher interest rate costs. So with that, we may very well see an uptick in inflation. Oil prices, ironically, have been coming down in the last month or so, so less inflation there. But certainly wages slowly but surely are beginning to rise. When we look at the unemployment rate right now, about 3.8%, this is the lowest unemployment rate we've had since 1969. There are more jobs out there, quite frankly, than there are people looking for jobs. So we are at the early stage, but I think we will begin to see businesses having to raise wages to try and attract workers. So inflationary from that perspective, but if people get raises, they'll probably spend that money, and in some ways that's actually a good thing. Back to my discussion about how much of the growth of the economy is a function of the consumer. And then finally, the trade tensions, those do still seem to exist. I don't foresee too much of a backtracking on some of the trade talk at this stage. So as these tariffs continue to roll out, that will probably be a headwind for the U.S. economy for specific industries. So there are some good things at foot here. The economy appears to be strong, but there are definitely some headwinds that are beginning to face us. Okay. So let's talk a little bit about, how all of this is influencing the different investments that we have in the Dassault plan. So these are the return numbers through the end of October. I've highlighted in green any fund that is outperforming its peer group, so doing better than average. And then I highlighted in red any funds that were underperforming their peer group. So I think as you can see here, we tend to be favoring more the green than the red, which is a good thing, and in some cases by a pretty wide margin. So the majority of the funds, and I would keep in mind the fact that this does take into account the dip in the market as well. We're not just looking at the sunny September 30th numbers. So you can kind of see how everybody has held up even with a relatively significant decline in the market itself. Keep in mind, though, with this, that these are just returns for 12 months. So it's hard to draw a lot of conclusions from just 12 months, or not 12 months, 10 months or at 10 months of performance. So my next slide here is looking at a longer period of time. So these are the 1 year, 3 year, and 5 year percentile rankings. So the way you read this is small numbers look good. So ideally, the smaller the number, the better. I'd probably focus people's attention on that 5 year column because that gives us a better sense of consistency over time. And I think you'll note, overwhelming majority of the funds here are ranking in the top half of their peer group. In particular, our target date funds have done extremely well. Those are ranking in the top decile of their peer group by and large. So I think the long-term picture with the investment options that we have looks particularly sound. So I figured I'd take just a little bit of time to remind people of some of the changes that we made with the plan effective October 1st. So hopefully everybody got the communications around this. I think there were a variety of different communications that came out, but I'll quickly summarize some of this. So we made a few changes to 3 of the funds that we had in the plan. We replaced the Fidelity New Insights Fund with Fidelity Contra Fund. This was an opportunity to reduce some cost and in some ways keep what had been successful and hopefully make it a little bit more successful. Roughly 60% of the New Insights Fund is run in the same fashion as Fidelity Contra. So we had found, looking at kind of the 2 of these funds, the longer term track record with Contra Fund was superior to that of New Insights, even though similar managers, actually the same manager in this case, but for a lower price. So we opted to replace New Insights with Contra Fund. Invesco Small Cap Value, we replaced with the Wells Fargo Special Small Cap. Both of these are about the same in price. Key difference here is much less volatility with the Wells Fargo fund. Invesco over the long run had very good results, but it tended to be kind of boom bust in nature. It would have some really, really good years and it would have some really bad years. So our feeling was we wanted to try and smooth that out a little bit. And that's where the Wells Fargo fund comes in. And then finally, the Franklin International Small Cap, we replaced that with the Vanguard International Explorer. Both of these have similar mandates. The Vanguard fund was about a third of the price of the Franklin option. So we decided to replace that one as well. And then finally, we also made some changes with the target date funds. We kept the same funds, still run by T. Rowe Price, but we were able to reduce the expenses on those pretty dramatically as well. In the past, as well, one of the other things that we've done is where we could is remove any what they call revenue sharing from the funds. So if any funds provided some revenue either back to Fidelity to offset any of the administrative costs, essentially we decided to eliminate that, or if we had a fund that provides revenue and there isn't another alternative, and that is the case with the Strategic Income Fund, we're going to credit that revenue back to the participants. So by doing this, effectively, it allowed us to reduce cost on a variety of these different options, the T. Rowe Price Fund, the Contra Fund, the Vanguard Fund. So sort of with that, in the past, we haven't had a deduction, so to speak, or a cost for having a 401k account open. The reason for that is because the funds basically generated enough revenue to cover the cost of the administration of the plan. So essentially, what we've done is we've reduced the cost on many of the funds, and instead of having the funds pay for the administration of the plan, we'll have an annual fee of $85, which will be deducted quarterly. It's not $85 per quarter; it's $21 odd per quarter from people's accounts. So. Quick summary, but that's basically the major changes. All of this, again, we had in communication in September around what was going on with the plan. So there was one other point that I wanted to just clarify a little bit, or maybe give people some help with, so to speak, is the Contra Fund and the target date funds. We're actually using what they call collective trusts. So these act like mutual funds, but they are not actually mutual funds. They are clones of the mutual funds. So the portfolios, portfolio managers, the strategies are 99.9% identical. But by using a collective trust, it's a way for us, again, to save some cost. The downside, I guess you could say, with the collective trusts, since they are not a mutual fund, they don't have ticker symbols. So sometimes people will use ticker symbols as a way to track the performance of the different funds that they might be investing in. So the point of this slide is to give you an idea of what the most similar kind of mutual fund version is. So if you didn't want to go to Fidelity's website to get performance information, you can use the ticker symbols here on the right, and that will give you an approximation of the returns for the underlying funds. You can basically assume that, okay, whatever the return of the Fidelity Contra Fund was, the K6 share class, the return for the Contra Fund pool is going to be the same plus a little bit. It'll be a little bit stronger because the expenses are lower. Okay. So, with everything that's kind of been happening with the market, I thought this would be a good opportunity for us to go through some ways of kind of looking at volatility in the market and thinking through sort of the thought process around how we're setting up our portfolios and how we're kind of looking at what's happening with our 401k investments. Because anytime volatility comes back into the market, it's going to cause people to get nervous, and it might cause people to make maybe unwise decisions. So the first point that I'll make here is the volatility piece, I would say, is very common. It's unusual when we don't have much volatility out there. So what this slide is showing us is, returns for the S&P year over year going back to, I guess, 1980. But then underneath in red, these were sort of the lowest drops that might occur over the course of that calendar year. I'll look at 2017. So numbers a little low here, but I think S&P was up right around 20%. But at one point during the year, the S&P was actually negative 3%. So as you can see with all the red dots, it's not uncommon for there to be periods of time year over year where the market gives back some ground. As I was saying before, though, for 2017, at negative 3%, it's below average in terms of the normal amount of volatility. If you look at all the other red dots, it's not atypical to see, 8, 9, 10% declines at some point over the course of the year. So volatility is not uncommon. This is part and parcel of kind of what happens with the market. So if that's built into kind of what's going to happen, then I think there are kind of 5 key points that we can try and keep in mind to help us better manage that. Number one, you want to have a strategy of some sort. So I think that strategy is really around reminding yourself about when you're going to ultimately be using the money. If you're 25 years old and we see the markets getting riled up, you do need to remind yourself, hey, I'm not going to use this money for another 40 odd years. So whatever is happening today, I still have 39 years, 364 days for the market to recover. And I think that sort of mentality is important to keep in mind so that people don't panic and people don't look to exit the markets too early. So having that strategy is important. On the flip side, of course, if you were getting out towards retirement age and you have 100% of your money sitting in stocks, you might want to think about that as well, and whether that is fitting with your risk profile, fitting with your risk tolerance. I talked to many people at Dassault over the course of the year. There are some people who are at the older end of the spectrum who have a fair amount of money in stocks, and they're good with that, and they understand the risks, and they are comfortable with trying to get a little bit more out of it, even if it comes with maybe some nasty surprises. But this is again an opportunity, I think, for people to relook at where their portfolio is. Being comfortable with your investments is sort of an expansion of what I was discussing right there, making sure you understand where you've placed your chips. We'll look at some slides along those lines. Spreading out the eggs, not having all of our eggs in one basket. concept of diversification. I'm sure everybody's heard this a million times, but I think it does still have merit. Rebalancing your portfolio, we'll talk about that in a sec, and then keeping at it. Even with the ups and downs of the market, dollar cost averaging, continuing to invest on a regular basis can pay some dividends. So let's talk real briefly here about, what these different portfolios might look like. So this is kind of under the heading of, knowing what you got. So we have 4 different examples of different portfolios here. Diversified, some in stocks, some in bonds, some in cash. I think the important part here is not so much the best 12-month return, but it's the worst 12-month return. As I've said before, nobody ever complained about having too much money, quite frankly. So usually my phone doesn't ring when the market's going up because there's not much to complain about. On the flip side, though, when the market starts going down, that's when people tend to take notice. And it's fine to take notice. I think the follow-up question is, does that drive you to do anything? Sometimes there may be periods where it may make sense to kind of relook at the allocation. And sometimes it may make sense to not necessarily do anything and let it ride. But I guess where I would go with this is to say, if the worst 12-month period for the aggressive growth portfolio is a negative 60% return, you might want to know what that downside might look like. And are you really comfortable with potentially more than a 50% loss? That might be a driver for us to relook at, how the portfolio is constructed. Does it have enough downside protection? So depending on how much you have in stocks, how much you have in bonds, how much in cash, you're going to get different characteristics. I mentioned the concept of diversification as another way to provide some degree of protection, perhaps, or to dampen some of the volatility in your portfolio. We've got a few different time frames here where we're looking at, what happens with an all-stock portfolio, what happens with an all-cash portfolio, what happens with something that's a combination. I think, generally speaking, what we tend to find with just the impact of diversification is doesn't necessarily provide a ton of extra return on the upside, but what it tends to do is help dampen some of the downside. So that's, I think, the first column here, January 2008 through the market bottom of February 2009. So, second worst decline that we've had, that diversified portfolio. Not thrilled about a 35% drop, but if we had a pure stock portfolio, which was comprised of U.S. stocks, international stocks, et cetera, large and small cap, you would have had a much deeper dive, so to speak. So I think, part of the art of this is coming up with something where, we all have to recognize there's going to be periods of time when the market goes down. We just saw that, but it's coming up with something where you can live with a certain degree of flexibility in the up and down so that you don't cause yourself to panic and jump out. This concept of rebalancing, I know I've talked about this before, but this is, I think something good to, again, remind ourselves about. Like I said, the market was up 21% last year. Market peaked at the end of September of this year. So as people look at their portfolios, we can surmise that there's probably some gains in your portfolio where some of your investments have certainly made money. So the idea of rebalancing, which would be to kind of sell off some of your winners and reinvest some of those profits in maybe some funds or investments that haven't done so well right now but might do well in the future, does a couple of different things. It helps to force yourself to take your gains off the table. And it also prepares you to make sure that your portfolio doesn't get too risky or too conservative. So I'll use an example from the internet bubble. If you started investing in in the market in 2005, and you had 25 or 50% of your portfolio in stocks and 50% of your portfolio in bonds or cash, which is kind of what we're showing here, you'll note by the time we get to 2015, your portfolio is no longer 50-50. You'd have roughly nearly 70% of your portfolio in stocks. And this was particularly typical. If I had 2000 here listed, that 50% stock portfolio likely grew to, even 75 or 80% of the portfolio without anybody doing anything. It's just the market going up and the stock piece becoming much bigger and the bond or cash piece becoming much smaller as a result. So when the market went down, instead of having just 50% of your portfolio exposed to stocks, you had 75, 80%. So the decline was much steeper than perhaps people had in mind. So this idea of rebalancing, selling off some of the things that have made money, using those profits to invest in some things that maybe haven't made money recently, but would be positioned for the future, perhaps to make money or to buy cheaply. That's what rebalancing could do. My last point here, and I think I'm doing pretty well with staying on track with trying to talk for about 45 minutes, is again, keeping at it. I think staying with your investment program, not being tempted to withhold contributions, stop contributions, et cetera, to the retirement plan, I think can pay big dividends, and we can see it here on this particular chart. So going back to one of the first things that we looked at, where have we come from? If you had jumped out of the market in 2008. Sure, you may have saved, or even a little bit before 2008, October of 2007, you may have saved a 57% decline in your 401k value, but then you missed a 331% increase in the value. So, even as the market was going down, if you were continuing to invest, you're buying the market at cheaper and cheaper points, both on kind of the downside here, but also as the market goes back up. All those points between where the chart caps out at October 9th of 2007, those are all buys. Those are all, relatively cheap investments from kind of where the market headed. So, keeping in mind what's our game plan in the long run, making sure that our portfolio isn't built so that when the market goes the other direction, it falls way too far for us and causes us to panic. And as a result, we suspend our 401k contributions, or we move all of our money into cash. These are sort of common investor mistakes, I guess you could say. So by trying to employ some of these other strategies of spreading out the eggs, understanding sort of the downside risk, rebalancing your portfolio will help you to try and stay on track. And that's, time is a key component in 401k plans. It's really what makes everything work if you can stay in for the long run. So in light of kind of what's been happening with the market, I thought it would be useful to remind everybody about some of these concepts because I think they're gems. They are old chestnuts, so to speak, that we can bring out and present to people to keep people on the right track. Okay, so for more information, certainly you can reach out to Fidelity. Fidelity's information is plastered all over the website, and we have Fidelity's contact information on the DISA website, on the intranet site. So certainly Fidelity is an avenue that you can reach out to for more information. Myself, my coworker Adam, if anybody wants to talk to us, if you have questions, concerns, etc., feel free to reach out to us. We're happy to chat with anybody out there. So with that, I'm going to wrap up my comments. I had my stop clock going. I am at 42 seconds and 15 parts of a second, so I'm going to stop my stopwatch. Colin or Bill, feel free to, I guess, open the lines for any sort of questions, and I'll try and tackle those.
Hi, Kendall. It's Bill. We do have a few questions I wanted to bring to your attention. Maybe you can help us understand some of these items. And you can hear me, right?
Yes, I can.
Perfect. Okay, great. And you may have already sort of touched on this, but I just wanted to bring it up because it was a question that came up. So if you believe there is going to be a major correction, is there a best case scenario to preserve value other than selling everything or sitting on the cash? Do you reduce stocks, increase bonds, et cetera?
Yeah, so I mean, I guess if your outlook is particularly bearish, so you're expecting big decline in the market, the place you would ultimately go would be cash, because that would prevent loss. So if you put your money into the money market fund or the managed income portfolio, one of the other sort of money market options that we have, it would prevent you from losing money. I think the downside with that is that it's very easy to jump out. If the market's going down, it's pretty easy to hit the panic button and slide into cash. I think it's twice as hard though to figure out the right time to move back into the market, because it's easy to talk yourself out of that. If the market is going up, you may say to yourself, well, I don't want to buy when the market's going up. I'm buying when things are expensive. Market continues to rise. I want to wait for a dip. All right. So you continue to stay out. Well, when the market is going down, same sort of thought. Why do I want to buy when the market's going down? Market's losing money. So that doesn't seem like a good time to get in. So I think that's the challenge that presents itself to people as they exit the market altogether, is figuring out where is the entry point, and then actually making that happen. So I think it probably, on the surface, the easy answer is, yeah, if you're bearish, you would go to cash. But maybe there's an in-between. Maybe the cash piece just becomes a bigger percentage of the portfolio, or maybe the bond piece becomes a slightly bigger percentage of the portfolio, and the stock piece becomes a smaller percentage of the portfolio. And you can, manage those pieces to, any degree that you see fit. Doesn't necessarily have to be 100% out. If you went from, 80% stocks and 20% bonds and cash to 50-50 or something like that, you are going to have different characteristics, and characteristics that are much more downside protection. So I guess with that, if the market turned around, if you were wrong, you were bearish and the market started going up, at least you'd have some piece of your portfolio that's going to grow with it. So that's my 2 cents on that one.
Okay, thank you. Another question. We had a few questions about the annual fee. Even though all the changes done in view to reduce or save cost, why are we getting a fee on top of that? And is there an option to have plan fees separately contributed outside of the 401k investment and outside of the limits?
Sure. So there is not an option to have the plan fees paid kind of outside of the plan. So that's it's sort of built into the plan itself as a deduction from people's accounts. So unfortunately, there's not something that we can do along those lines. I think the spirit of the fee, though, is at the end of the day, the fee has always been there. There's always been a cost to administer the retirement plan. I think probably intuitively people know, nobody does anything for free. So it's not like Fidelity is running the retirement plan out of goodness of their heart. They're certainly charging for the computer system, for the call center, for all the technology spend, et cetera, for the communication materials, et cetera. So all of that is there. I think the difference is in the past, or up until this point, those expenses have basically been borne by the funds themselves. The funds have had, for lack of a better term, revenue inside them to be able to offset some of those administrative costs. So even though you may not have seen a deduction from your account, you may have had a higher fund expense. So there's kind of two things at play here. Not all of the funds necessarily shared any revenue back to Fidelity. So for some individuals, depending on the funds that you are in, if you were in funds that didn't share any revenue, you effectively got a free ride. You weren't contributing towards the cost of the administration of the plan, where others were contributing more heavily towards that cost. So by doing away with the revenue sharing where all the funds don't share anything at all, or if they do, in this one case with the Strategic Income Fund, the revenue is passed back to the participant, everybody kind of shares or pays their own way. They pay their fair freight towards the cost of the plan. So, this has not necessarily been we're just going to impose a charge. Other things have come with that. The target date funds have all gone down in expense. The Fidelity Contra Fund has gone down in expense, or the new fund is less expensive than what we had before. The Vanguard International Explorer, a third of the price of the Franklin International Fund. So other things have come with this change. So at this stage, we think that this is a fairer application of the cost of the plan. Everybody pays the same price, whether you have, $100,000 in your account or $1,000, same cost. It's very transparent. Everybody knows exactly what it is. As DSO continues to grow and as we add more bodies, that fee will go down over time.
All right, thanks, Kendall. Question back on slide 8. I don't know if you can flip back. Okay. Can you clarify what you meant by the big tech companies being big percentages of the indexes? Is that by market cap relative to other index companies?
All right, I'm going to the slide here.
Okay.
All right. Apologize. Well, everybody gets to see the presentation one more time here. Almost there. So while I'm scrolling through the slides, so this is about market cap. That's what I was alluding to. So when we look at the S&P 500 index and the NASDAQ for that matter, the stocks in those portfolios are weighted by their market capitalization. So they represent, it's not like all 500 stocks in the S&P are equally weighted. Some represent a bigger component of the index and some represent a smaller component of the index. So if you look up what component of the index each of these different names represents, I did the math on it already. If I add up these 6 stocks, they account for 16.26% of the S&P 500 index, their weight, their market capitalization. So as these 6 individual stocks increase or decrease in value, they're influencing about 16% of the value of the S&P index as a whole. And it becomes, even more prevalent as you look at the NASDAQ, which is much more technology-based or technology influenced, where just these 6 stocks are influencing basically 25%, I'm rounding up, 25% of the movements of the NASDAQ. Hopefully that clarifies a little bit more.
Thank you. Another question, do we see any pre-contraction or pre-recession indicators that we've seen in the past? Anything that you're noticing?
Yeah, I mean, not too much. The one that people seem to be focused on right now is back to interest rates and the yield curve. So I don't have a slide on that, but basically what the yield curve tracks is what is the interest rate on different maturity bonds. So what's the interest rate on a 2-year bond, on a 3-year bond, on a 5-year bond, on a 10-year bond, on a 30-year bond. So ideally what you want to see is bonds with a shorter maturity pay lower interest than bonds with a longer maturity, which makes sense. If I was going to tie up my money for 30 years, I'd want someone to pay me more than if I'm only tying my money up for 2 years. So that's normal state. Normal state is you see this kind of upward sloping curve with yields on different bonds. If we looked at the yield curve right now, though, it doesn't quite look like that. So what's happened is, as the Fed has raised interest rates, what it's done is it's pushed up the interest rate at the short end of the curve for lower maturity bonds, 2 years, 3 years, etc. But because the Fed has been going through this program of trying to keep interest rates down as a way to spark the economy coming out of 2008, the interest rates for longer maturity bonds really aren't that high. So right now, for example, if you buy a 10-year treasury bond, you get a little over 3% interest on that. So, right now, that, believe it or not, that it doesn't even sound so bad, but a year ago, the interest rate on a 10-year treasury was about 2%. So you're locking your money up for 10 years in a row to earn only 2% a year. I mean, inflation right now is running about 2%, even a little bit over as we sit here today. So you're not even breaking even with inflation, you're actually moving backwards. That was kind of where we were a year ago. So the point of this is when you see what they call an inverted yield curve, where bonds that have shorter maturities are paying the same or perhaps even more than bonds with a longer maturity, that's a recessionary sign. That's not good. So we're not at that point right now, but if you were to look at that yield curve, it doesn't have sort of a dip to it. It's beginning to be more of a straight line. So that element of it would be a pre-recessionary sign, the yield curve. Some of these other things, though, still look attractive. Whether that's where the jobs number is, where inflation is, relatively speaking, where corporate earnings are. We haven't seen a big decrease in corporate earnings necessarily. So, if I had to pick one thing, I'd probably point towards the yield curve, but there are some explanations around it. Part of the reason it's been flattening is because the Fed feels confident about the economy. That's what Chairman Powell was saying, is the U.S. economy still looks pretty good. So it's okay for them to try and raise interest rates and get them back to a normal place, because we've had basically 10 years of abnormal interest rates. So.
Okay, great. And I think we're just going to do one more question, and if you could, Kendall, just put your contact information back up on the screen.
Sure.
We had a lot of great questions that came through, and unfortunately we won't be able to get to all of them. But certainly reach out to Kendall or Adam with any questions you may have. They're here to support us. So my final question, of course, there's an election going on today, right? So
yes.
What kind of things happen when elections come about? What fluctuations do we see, whether midterm or every 4 years?
Sure. I don't know if anybody remembers. I think I've put slides like that up before in the past, in and around election times. Usually with elections, there tends to be a short-term bump. It could be in a positive direction or in a negative direction. But generally speaking, 3 months, 6 months out, the impact of elections don't seem to have that much of an impact on the market as a whole. So, The aberration with that to some degree was 2016, where we saw a big run up in the market and a relatively sustained run up in the market with the presidential election. Obviously, a bunch of different kind of reasons or explanations as to why, sort of a big surprise, I guess you could say. Market didn't really account for it in terms of Trump winning the election. So it's very interesting to kind of see sort of what was happening with the markets 24 hours after the presidential election, where you could hear all the abacuses spinning and spinning as every kind of Wall Street firms started redoing all their calculations about their expectations for things under a Trump administration. And, in that particular case, we ended up with a much rosier outlook. But kind of outside of 2016, at least historically speaking, the impact of, a Democratic government, the impact of a Republican government, at least in terms of where the markets go, is a very small impact. It doesn't seem to have a ton of correlation.
All right, thank you, Kendall. Thanks again for your time, and I appreciate certainly you being here, and thank you everyone on the phone for attending the call. Just a reminder, we will be posting all of these slides and the presentation recording on the rewards@3ds.com website. And one question came in. There is an underscore between your first and last name on that.
Yes, that is true.
Okay.
I'm glad they mentioned that. Yes, so that is
Kendall
true.
Underscore Storch. Yes. All right. Thank you again, Kendall, and thank you everybody for joining the call.
Thanks so much for the time.